Good morning and welcome back, everyone, to the Schwab YouTube coaching channel. It's our Monday edition of Trader Talk. It's today's market, and I am your host, Kevin Horner, joining you from a beautiful and sunny Denver, Colorado. Today, I am pleased to have this gentleman back. It's been a little bit of time. My friend and senior manager, or actually, that's not even true anymore, Jeff. You're not a senior manager, sir. You're a director, if I'm not mistaken. Is that correct? Of trading services, Jeffrey Avalos. Great to have you with us, Jeff. How you doing?
Yeah, glad to be here. I really don't care what title I have. I'm just happy to be here with you and all of our wonderful viewers talking about the markets on a gorgeous Monday morning. And for all of you out there, happy Hanukkah. I know it started yesterday, so mazel tov.
Well, Jeff, thank you for bringing all of that. And I'll just say maybe we'll just refer to you as our sharp-dressed man, without a doubt, always bringing the proper attire. I love to see you here and love having you, obviously. Today, we're going to get to a number of key points. So the market is giving us plenty to discuss as usual. I will remind you, though, we're joined by Brent Moores in the chat as well. The three of us will try to answer as many of your comments and questions as we can today, excuse me. So please feel free to continue to post in the chat for the duration of our show. Jeff and I will keep an eye on things, and Brent will be there to pick up the slack that Jeff and I miss. If you're looking to follow Brent and me, we're available for you on X. It's the best way to meet up with us coaches when we're not hosting classes for you here. So you can meet us there, Brent Moores, CS, and Kevin Horner, CS. We'd love to see you there on X. Let's get to our disclosures, everybody, and then we can dive right on in. So real briefly, remember that our conversation here is informational and educational only. We do not make recommendations. We do not endorse a specific approach to trading the market here. We will, however, incorporate technical analysis in our discussion. As we do that, really what we're highlighting are just concepts and strategies traders may choose to employ in their own process. Please remember not to base your decisions exclusively off technical analysis. As it relates to our agenda, we follow a top-down method here, meaning we start broadly and whittle our way down through the groups of the market. So we'll start with our major indices, the S&P 500, the NASDAQ 100, and the Russell 2000. We'll flesh that out a little bit. We'll probably look at semiconductors and then in some sector spaces as well on the move today before getting to a whole bunch of upgrades and downgrades today. So we're going to look at a bunch of individual equity charts, but we will kick it off with the SPX here. And Jeff, Friday didn't leave many traders feeling all that fantastic, did it?
No, I think that's really captivated a lot of our attention as traders is, do we break past that resistance? And you had a little bit of help right there at the beginning of the week. You go, yes, I think we've got it. Here comes that bull run. What's going to happen as the Santa Claus rally either does or does not materialize? I'll talk about some statistics here in a little bit. But Kevin, I think there's a few positives and a few concerns right now on traders' minds. One, the positive. You've got the 20 above the 50 holding that nicely. So that's that orange line above the purple line. So that's a positive. Now, the tough part, I think, for a lot of traders out there is, gosh, we really had some momentum as the week started to unfold, and then you see Friday just kind of bring us down, and you go, oh boy, what happened to that rally? And is that going to continue as we move into the rest of the week? So I think that's probably captivating a lot of traders right now to see, are we going to hold that resistance, or can we break past it and form a new support level?
Yeah, I think that's exactly it, Jeff. And I also think that traders are wondering, well, can we believe in this little uptrend that we've basically been holding in here, right? And that's all been since we broke the downtrend line here, this gap up on November 26th. And we've basically, for the better part of this, held the uptrend line there. So short-term traders feeling a little fine. But I think the level you called out, very important ledge there, that 20 and 50 confluence, an area under which traders are perhaps interested in maybe reducing position size, unless they say, you know what, I can take the move all the way back to 65.40. I'd be comfortable there. And if you're that trader who says, no trouble, we fell through 67.60 and I'm suddenly at 6,500 or so, I'm comfortable with the amount of dollars I've got devoted, then you're in a good space. If you're the trader who says, you know what, that's a little more risk than I am comfortable with, then a trader might lighten up or reduce position size if we close below that, those trending moving averages there, the 20 and the 50, ever important for us. And Jeff, we do have RSI downsloping, so it implies at least that the rally back hasn't been quite as strong. which is not really a shock. You know, there's been a little trepidation about the rally nonetheless. Now, the one thing I wanted to ask you, you mentioned it, seasonality heading into the end of the year, the so-called Santa Claus rally could certainly play out. What window of time are traders generally looking for as it relates to the so-called Santa Claus rally?
Historically, the Santa Claus rally, when you're talking about that particular phenomenon, it's the last 5 trading days of December plus the first 2 of January. Now, before we share a little bit about the insights on the Santa Claus rally, Kevin, this Friday, Triple Witching Friday. It's the last one of the year, and it has historically been one of the best weekly returns of the year. Strong institutional repositionings happening during year end this week. So keep an eye on that. Now, Triple Witching Friday, that day alone, the average return is between 18 to 21 basis points. That's across most every single year. So that's historically very positive. Now, Kevin, we always say this, and certainly as we look to the beginning of this week, it's no exception. Past performance is no guarantee of future results. This could be one of those times where you go, gosh, that Jeffrey guy came on and he said historically about the Triple Witching, and I thought it was going to be wonderful. And here we have this down week. So keep an eye out on that. Now, let's talk real quick about the Santa Claus rally, Kevin. Let's not focus so much on when it materializes, but what if it fails to materialize? So when the Santa Claus rally fails, again, that's the last 5 days of December and the first 2 of January being either flat or negative, January as a month is down around 70% of the time. Now, the full year, when that happens, finishes lower 70% of the time. So watch out for that. The other thing I'll share is the January effect. So if the S&P 500 is up during the first 5 trading days of January, this is not the Santa Claus rally we're talking about. Now we're just going and focusing on January. So for those of you keeping notes, watch out for that. If the first 5 trading days of January are positive, the full year is positive 86 to 88% of the time. And the average full year gain is around 14 to 16%. But if they're negative, the year is positive only 50% of the time. And the average full year return, get this, less than 2%.
Yeah.
Ouch. Ouch. So what is everybody, if you're in the bull category, you better be cheering on January like a mamma jamma, because that could lead to better returns throughout the year. Now, Kevin, I don't know if everybody caught this. We might want to give a plug for the 2026 Market Outlook. It's in YouTube. It's on the Schwab Coaching channel. But Liz Ann Saunders did talk about the second year of the presidential election cycle, which is coming up this midterm election. Now, historically, Kevin, that is the worst performing year of the 4-year presidential election cycle, with year 3 historically being the best. So what might a trader be looking out for as we move into the rest of the year? Watch out for that Triple Witching. Let's see if it materializes and it holds strong as it's done historically. Watch out for the Santa Claus rally. Ideally, we'd like to have that going into January, and then you want that positive momentum to continue in January. If we don't see the Santa Claus rally materialize, Kevin, if we don't see the first 5 days of January as positive, and if the January barometer, which is the entire month of January, do not show up positive, I think there are going to be a lot of traders and a lot of institutions repositioning for a little bit of softness in 2026.
It's an excellent explanation. I'm glad you took the minute to flesh that out, Jeff. Thank you so much. I'll mention I dropped in the link for the 2026 Market Outlook into the chat, everyone. If you have the time, we strongly encourage you to watch through it. Obviously, a lot of good insights. The one thing we try to remind you all about in these classes, this is a conversation around probabilities, never certainties. But the more we consider the probabilities, the more prepared we can be to manage those possibly playing out, whether they're positive or negative. But we have to give thought to these. We have to build our own thesis and our own plan for our comfort as to how we're going to trade and or invest heading into 2026. It's going to be a busy year. There's no doubt about it. There's going to be a lot going on. But I do think that Schwab Market Outlook can help us to just set the table for the coming year. Plenty that we're going to be talking about, obviously, on the channel all year long. So thank you, Jeff. That was some really good insights that we obviously don't get to in this show as frequently as maybe we could. But being that we're heading into the close of the year, and it's been a banner year, as it turns out, some very good insights discussing that. Now, Here, as we shift over to the NASDAQ 100, Jeff, again, that ugly candle day we had on Friday, I'm going to go ahead and zoom in. Ugly in the sense that it was a big red filled in candle that brought us back to the confluence of the same 20 and 50-day moving averages like we saw with the SPX. I imagine the analysis kind of fits the mold of the SPX as well.
I would think so. And notice too, everybody, 20 and that 50, they are right there together with one another. And you've even got that lining up fairly close with the 25,000 level, a big psychological number in the minds of a lot of traders. So again, Kevin, what I think you have here is what you like to talk about on the show. If you're going to take a risk on position, meaning a bullish position, you might want to consider tightening up those stops. Don't give a lot of wiggle room below that level that Kevin has highlighted here, because you can very quickly see either I am correct, fantastic, this trade is working out, or I get that instant gratification of knowing that I was wrong. I am going to be getting out of that trade with a nice tight stop, Kevin.
That's the idea, again, we're all very different. We don't know what your preference is, but what we want to do is at least open your eyes to allow you the comfort to manage the trade you want to manage, the way you want to manage it. Some of these levels will matter to some of you, and for others they won't. They're going to be too short term, and they won't have the impact given your time frame or maybe your comfort and tolerance for risk. So it changes for all of us. But
Hey,
that 50
Kevin,
day,
question
20 day
for you, by the way.
confluence. Say that again.
Sorry to interrupt you. Question for you. I'm just curious. This is coming to mind right now. We're looking at the NASDAQ. It's not up as high as where the S&P 500 is, where it's hitting that new all-time high. I'm curious your take. Would that spell out to a trader, wait a second, if you don't have the NASDAQ potentially hitting new all-time highs, it makes it even harder for the S&P to really rally strongly into the end of the year? Or is there anything that us as viewers can draw from that?
Well, I appreciate that question, but I'll say this. I actually think that that tells us a little bit more about the health of the rally, perhaps. Doesn't mean that the rally necessarily has legs, but what it might be telling us is that the allocation of the SPX, being that it is heavier components in industrial, financials, healthcare, are the things that are buoying the SPX versus the NASDAQ, which is not getting that allocation buoy. So if we looked at, for example, the heat map here in the S&P 500, you can see where the biggest companies reside, everybody, over here in tech, right? Our monsters are over here in tech. But you can see there's a lot of green on the screen in what should be considered to be, our defensive groupings, Jeff. The financials are doing well today. Healthcare, staples doing well. But if we looked at this on the NASDAQ 100 level, those groups are dramatically fewer and far between. Look at how small the financial space is down there, or even utilities, industrials. You're just not getting the participation in the NASDAQ 100 there.
Gotcha. Underlying components matter is what I'm hearing.
Absolutely. Absolutely.
So thank you.
I think it's got something to do with that. And then if I was, there's a, let's see here. I thought I had a SPX. Let's see. There's an equal weighted index, SPXEW, if I'm not mistaken. Yep, there it is. Nice. So Jeff, this is a good example of it, right? Look at that, equal weight. So quickly, do you mind defining this for our viewers? Equal weight versus what we get out of the SPX. So SPX versus SPXEW here. Why is this different?
Yeah, you might have to help me out here, but as I understand, Kevin, the S&P 500 does the market cap weighting. So the biggest companies get the largest weighting. I think right now, NVIDIA is about 7% or so. Microsoft, Apple, right behind them. The equal weighting, though, again, as I understand, check me on this, Kevin, but equal weighting says we are going to give the same weighting across the spectrum, which would lead to the breadth that we are seeing. So if you have different components, meaning sectors of the S&P 500 all participating, the equal weight would be outperforming the market cap weighted S&P 500 that we're used to seeing. Did I get that right? Or is there anything I missed there? Is that okay? I get lucky sometimes.
I think, come on, we know better than that. The way that I look at this is exactly that. Yes. So we are getting an even distribution in all 501 companies there, which tells us that there is some leadership from areas that otherwise haven't been leading, right? We have largely in 24 and 25 led by tech, led by semiconductors, aggressively moving to the upside. Well, the S&P, we're not seeing that out of some of those other AI plays have been a little bit under pressure of late, and yet here we are with an equal weighted return index at all-time highs. So that actually, as I see it, that bodes favorably. That speaks to a bit of a broadening out of the leadership now, which could be better for us moving forward. Now, narrative-wise, Jeff, that doesn't necessarily mean it's all that great, because if we're going to see tech under pressure, that's going to put a damper on returns. There's just no way around that. Leadership from defensives tends to be the years where we lag. There's just no way around that. You just don't get the movement out of your staples in healthcare traditionally when they're in the lead. It would be my comment on that.
Very good insight.
Let's look at our small caps here, because the move to the upside in the small caps has obviously been driven by the improvement of the yield curve improving, as well as the yields coming lower. The rate cut certainly helping us out a little bit here, Jeff, breaking through to new highs just last week.
Yeah. Well, what the insight tells me here is that, remember, everybody, the smaller the company, the more they are subjected to interest rate risk. Meaning, if interest rates are high and they're doing a lot of lending to secure their business, to make sure they have all the things they need moving the market, that can make it very, very difficult in a high interest rate environment to be pumping out returns. In a lower interest rate environment where the Fed is lowering interest rates, as we've seen over this last cycle, that makes it a little bit easier for them. They're getting loans at a more favorable rate, and they are able to make higher profits. So I guess a really good call out, Kevin. It doesn't surprise, I think, a lot of people that the small caps are moving positively. What I get a little bit caught up on, though, is I thought small caps were supposed to be the leaders in the market cycle. And if everybody's saying, hey, there's this AI bubble, weakness in 2026, a little bit of a shocking movement as the Russell hits new all-time highs. Anything you can pull from that? Would it be, well, give more weight to the interest rate environment and less to the leader of a potential downturn in the market cycle? I'm a little caught on my heels here.
I think it's more tied than anything else to the rates. I think yields coming down, the expectation of yields coming lower has a majority of it going on in small caps. I don't think there's any way to look at this alternatively, because when you look at the 10-year, for example, here, yes, we've rallied into that 4.2 level, Jeff, but we shouldn't be surprised that that's the level from which we've been beaten back now. Yes, we broke the downtrend. It's going to be interesting to see how we manage it in this, 4.8 level, 40.8 up to the 42, because this is, the difference between a potential new high in yields versus breakdown or pullback to the lows that we've seen of late. And certainly maintaining yield down at this area, keeping these yields in the vicinity and below 4% would do well for the small caps. So I think that the story is there as it relates to small caps is tied to the yield more than anything else. And further, when I was looking last at the CME Fed tool, the expectation for a year out is to be about a 75 to 100 basis points under where we are right now, which would imply 3 to 4 additional cuts in 2026. Now, obviously, that remains to be seen. There is, of course, the potential, if not the likelihood, of a new Fed chair, which we've not heard any definitives on, just a lot of name and posturing. So let's not go too far down that path until we know more. But if the administration gets its way, it's apt to be an individual who's going to be a little more easy on policy, Jeff.
Yeah. A question for you. I'm seeing it in the viewers here. Wonderful question, too. How does it help small caps if only the short-term rates are down, but not long-term? Do they only take short-term loans? Any insights on that, Kevin?
Well, this is me speculating, but my answer to that would simply be, I think from a business standpoint, it makes sense to be nimble in your rate situation, right? If you are locking in to paying down debt, you want to take advantage of the fact that rates could be going lower still. So locking in a window right now to current rates, you don't want to think about current rates. If you're expecting rates to go lower, Jeff, you don't want to lock in for an extended period. You want to get the opportunity to capitalize on rates decreasing even further. So if you can work with a shorter term window, it can be far more beneficial than considering the longer term one. That would be my thought. What
Yeah,
about you?
yeah, revolving credit too could play in there. Brent had a really
Sure.
good response. Longer term yields do affect the small caps. The general downtrend is happening over the last 6 months. That's probably helping them as well. And thank you very much, Brent, for helping us with that. So good insight.
Absolutely agree. Hey, I noticed we got a survey in the chat there, everybody. If you don't mind, we would love to hear from you. Always value your opinions. Got some great feedback in the last few sessions I've held, so always love hearing from you. If you take a moment just to click that link, it's going to open right next to this browser window. You can get to it post-show. You don't have to worry. It only takes about 60 seconds. If you want to offer comments, those come directly to Jeff and me, and we always love hearing from you. So thanks for taking the moment to do just that. Jeff, we got to move on.
Yeah.
Let's talk about what's happening with our semis here. Semiconductors rallying a bit today, but that again, throwback candle to the confluence of the 20 and the 50. I feel like a broken record because that's exactly what we've been talking about with the SPX and the NDX both.
Yeah. Well, notice that this time when you're looking at the semis, you got a little bit higher, whereas the S&P 500 bumped right against that resistance level. So this one moved up. One of the themes that I was trying to eye up, I don't want to pontificate and say, hey, watch out for this, but watch out for this potential head and shoulders movement. So this is, I don't think this is quite far enough of a head movement from the left side shoulder. And if you want to know more about head and shoulders, take a look in the Schwab coaching segments. We've got all sorts of technical analysis that talks about that. But Kevin, one of the things that I think traders have on their mind is not just for the semis, but also for the S&P 500. Let's say we do rally into the Santa Claus rally and into January. But then we get weakness immediately after. That would be the head forming of a potential head and shoulders pattern. Now, if we can't get past that, moving into, call it March, April, that may be the right hand shoulder formation of a head and shoulders, which would be very, very unfortunate maybe in 2026 to start off the year. As we look at the semis, you're going to get some traders out there saying, hey, wait a second, he's right. That could be a head and shoulders. Generally speaking, though, Kevin, as I understand, you want that head to be a little bit higher up if you're going to be seeing the start of a formation of a potential head and shoulders pattern. Am I correct on that, or anything you want to polish that pearl on?
You know how that works, Jeff. It's all in the eye of the beholder. I think more than anything else, the idea that it is a potential pattern that a trader might see developing is the key takeaway here, because it reminds us that we need to be setting some ideas, some things that could occur, things that we would like to see happen, things we don't want to see happen, maybe leaning into the things that we don't want to see happen so that we can manage our risk appropriately. But I think it's very important. I agree with you. Generally speaking, if we're going to rally into making a head and shoulder top, some traders would consider a move to the head to be needing to be a little bit more explosive to the upside, maybe with even an increase to volume as you make that head, right? A little more, not to suggest it has to be a blow off top, but rather just a move to new all-time highs, in this case with big volume, which would give the impression to the bulls that it's a bullish move and there's nothing negative about it. And then it would obviously lead us to watching the right shoulder develop. Hopefully in that scenario, if you're expecting a right shoulder would be, in my view, on lighter volume to a level that would be more, in the vicinity of the left shoulder, in sometime, if more often than not, exceeding the right shoulder, kind of giving that head fake move, so to speak. Gotcha. That's what I commonly look for, but by no means does that mean I'm right, Jeff. You know that.
Excellent insight, though. That's what I was looking for, my friend. Thank you for highlighting that.
Absolutely. Now, Jeff, I'm noticing something under development right now. The SPX has been a little higher today than we are. Let's just look at this on the intra period. So we opened above our pivot point. We're selling down a little bit. But Jeff, what caught my eye here was the VIX popping up about 4%. Now that's not a huge move. We are well below our moving averages here, so we're not seeing the VIX trending in any way. But could an elevated VIX just be tied to the fact that it is triple witching this Friday?
Yeah, I think most certainly. Yeah, absolutely. Going into triple witching, you've got a few different options that are going to be expiring. So that's something that people are looking out for. You could also see, as the S&P 500 is pulling back a little bit in that Friday movement, you might see some institutions saying, You know what? Let's just secure our bonus and go ahead and throw on a few hedging positions. Let's make sure this works out okay for us as we come into the year end. Nice little return on the S&P 500 overall. I think they'd probably want to hold that in there just in case the Santa Claus rally doesn't fail to materialize. But I think you're absolutely right, Kevin. As you're looking at those moving averages, the VIX still well below there, very, very low from a historical perspective throughout the entire year. I don't know that anybody's saying, "Uh oh, watch out, this is an early warning sign." But I also don't think they're saying, hey, just forget about the VIX entirely and let's not think about it. I think as the rest of the week plays out, this might be something to look out for. I don't know that a lot of traders would be surprised to see this go a little bit higher coming up to that 20 or 50 period simple moving average going into triple witching on Friday, Kevin.
Yeah, it's not a shock at all. I think, again, understanding why the VIX does what the VIX does around known events can be helpful to the traders, right? More than anything
Yeah.
else. So that way we don't lose sight of what's happening with volatility. Volatility is important. We need to keep an eye on it. But an elevated VIX does not mean the sell is underway. I just
Yeah.
like to remind ourselves of that more than anything. Jeff, I want to look around at our spaces on the move here from a sector standpoint today. Leadership showing up in healthcare. Healthcare having bounced beautifully. Talk to me about the technical analysis tenets of this chart, buddy.
Look at that. I mean, right, comes right off that line you highlighted at what, 17.5 or so.
Yep.
Then you've got this nice little rally. You've got some volume helping out there. And then look at that, look at that, look at that. Right above that 20 period simple moving average, holding it just nicely. I think that could spell beneficial if it holds. Now, remember everybody, and Kevin talks about this all the time. One day is not enough to say, yep, great, we're in the middle of a rally. You probably want to get confirmation, give it a second, maybe even a third day before you start taking some bigger positions. But Kevin, I do want to call out, I don't know that this would be a flag pattern. However, that big update that we saw last week and then the follow throughs after that, if it were to start to come back down and hold that 20 period simple moving average, that could be argued for somewhat close to a pennant pattern.
Yeah, it could. I think the thing that stood out to me more than anything was the
What's that?
throwback to the breakout, right? I mean, it was a
Yeah.
clear breakout zone, right?
Mhm.
Highs on the year were here. And then we built this monster 3-day rally,
Wow.
followed it up with a bull flag, and then
Yeah.
broke it to the upside again. Not at all surprised to see the revisit of our breakout, one of those very commonly incorporated technical tenets. A breakout will frequently get thrown back for a test of support. We got it. And then the one thing that I drew in was the rectangle day. That was your hold, your close above the high of the low day, possibly a day where traders got a little bit more enthused on healthcare there. It has been it hasn't just been the sector. It has a lot of this move has been tied to biotech. I'm going to utilize my Dow Jones indices here. So DWC BTC for biotechnology. And you can see that that's working to get itself back in gear, Jeff. Pretty important level it's run into here. Taking a little bit of a pause at the 20-day. But this could very well be getting itself right back into gear on its rally. So always check your components. Always look down and always look into the breakdown of your sectors. Obviously, every sector has industry and sub-industry groups. Some will be leaders, some will be laggers. Also important, I thought, Jeff.
Yeah.
Consumer staples is moving to an important level. And the reason I wanted to talk about this was largely tied to the fact that it's a risk off scenario. If staples are leading, it generally means that money is flowing out of our higher risk investments and people are less comfortable.
Right. Yeah, that's the idea. It's to go in defensive, essentially. Consumer discretion, think like cars, the stuff you want, that is more risk on. Oh, people want to buy cars. This is going to be a wonderful rally. Consumer staples, I just want to get the very basics. Give me the toilet paper. So as you're seeing this little rally movement, that could be that risk off idea, cycle, thought process, whatever you want to call it, Kevin. But notice too, you have a really good call out, my friend. That is at the 50, 200 period in blue.
200 right above us.
Yeah.
Yep.
So that 200 period, I think, is probably going to get a little bit of amount of attention from a lot of traders simply because it's been noticed before. Check out October. Went up there, bounced off that a few times. You go back into September, it gave a little bit of attention. When it was pulling back in mid and early August, held that as your support level. So the market seems to be paying attention to that 200 period simple moving average. But Kevin, that could also be a possible flag movement. It goes up, holds on to that 200, comes sideways for a little bit, and then boom, it breaks up. What would have to happen for that type of environment to occur? You probably see a risk off in the overall market, some sort of news that really drives people into the fear category as we come into the end of the year. But Kevin, I don't know, would you be surprised if this entire week it just sits along that 200 period and doesn't really know what to do with itself?
No, it wouldn't shock me. Again, with the belief being, if traders are of the belief that we should rally into the end of the year based on everything we've kind of highlighted thus far.
Mhm.
Traders probably would expect this to be the spot from which it gets pushed back. That certainly doesn't mean it's going to go that way. Obviously, it worries many a trader, I'm sure, that we break through here. If we see the staples start trending on an upward trajectory, it should speak to us. We should pay attention. Okay, couple of quick ones here. Industrials broke to the upside out of the range last week, so this is kind of nice to see if you want to be long. Industrials moving to new highs, and the same can be said about financials, which we called this out as well. And again, I think the financial thing, it's nice on the yields, but Jeff, it's maybe as much as anything else tied to the 10-year. And what I mean by that is actually the yield curve. So let's just quickly look at the 10-2 yield curve. I think I might have messed up my symbol on that.
How you remember all these symbols, by the way, let's just call that out for the audience here. Kevin's popping in symbols right and left. I didn't even know that was available in the Thinkorswim platform. So kudos to you, my friend, for being able to remember all these. I mean, it's truly remarkable. Yeah, it's a savant. Golly.
So here's your 2-year look on the yield curve, and financials have followed the yield curve pretty well. I think that's why I wanted to bring it up more than anything. We're in a bit of a consolidation, but you can clearly see that the yield curve has been moving up with it. And if we take a look at what financials look like over the same window of time, well, you could see that there's been a little bit of a correlation, maybe not causation, but certainly correlation, right? Yeah. So I wanted to highlight that. And then at the request of, let's see, was it Rita? Yeah, Rita, let's look at transports for you. They're off a little bit today, but this space was tremendous. Look at this pop we got, Jeff, from this low here on 11.19. If I put a line on it so that I don't have to do the math, how about to the peak? 14% for less than a month. 3.5 weeks. Not too shabby for a big space, right?
Yeah. Well, I remember I was on the show about a month and a half ago. And before this breakout happened, one of the things that you had called out was, hey, Dow theory, you want to see the industrials confirmed by the transport, which we hadn't had yet. And now you do have a little bit of a confirmation of industrials are moving north and so are transports. What that exactly means for the rest of the year and all of the statistics that we talked about earlier, I have no idea. But I would imagine for a lot of folks out there, this could be a positive argument, a bullish sentiment going into a historically weak year in the presidential election cycle, Kevin.
Some investors might watch these two charts, right? For that reason, if maybe you're a long investor who's been paying attention to Dow theory for many, many years. This is kind of notable. That double top is standing out. We'd love to see transports pop through there, provide additional leadership, additional insights. But these two right now look far better than they did just a couple of weeks ago, because when we were stuck down here, this wasn't giving us much at all to work with, right? And now you're getting a little more validation of the move to the upside. Doesn't mean it has to stick. Doesn't mean anything in reality. But this is something that many a trader, or I should say an investor, have been keeping a close eye on. Okay, Jeff, we got to get to some of these stocks in the news because there are a bunch. Now,
all right, let's do it.
I mean, so many. Two I want to start with are not in the, they're part of this space. I'm looking at home builders quickly here because the home builder space has been improving, and you can see there's a little bit of structure shift in the way that the home builders have acted. I've got a lot of ovals working against the 20-day moving average, and you'll notice here we basically just did the exact same test of the 20-day. Now you're crossing to the upside. But the upgrades that come into this space are on the companies that support this area, Jeff. Today we got upgrades on Masco, which is going to provide materials. So Wells Fargo upgraded Masco to overweight from equal weight, and they put a target here at 75, up from 70. Now, the 75 level stands out to me, Jeff, as the recent highs. So that kind of calls out to me here. But the thing that also stands out is the fact that this stock has been under pressure, and we've moved off of recent lows. And so the analysts are maybe a little bit ahead here instead of being behind. Commonly we get these changes only after the stock has already corrected itself.
Yeah, yeah, and keep in mind too, interest rates going lower helps out the home builders. They're able to build the homes, taking out loans. They could give more favorable treatment to people buying those houses, so that could help move them. But I love that call out there. Their price target right in line with that year high in September. So that is, or maybe, excuse me, mid-year high. It looks like they were a little bit higher coming into the beginning of the year, but definitely getting ahead of the curve there, Kevin. Good call out.
Yeah, I agree there. And then watch the 65 zone because we've seemingly banged our heads on that one a little bit. The 50-day is down sloping into that area. That stands out. The other one in this space as a, someone doing something tied to home builders is Trex.
Mm-hmm.
So this is the decking. Now, this is interesting because the stock is substantially lower, Jeff. Let's see what the return looks like year to date. Let me just click that. So year to date, off 50%. Goodness gracious. But they were upgraded at Jefferies to buy from hold, new target at 42, up from 39. Again, in the space of home builders, clearly a lagger. But if it's a group that's going to get in gear, boy, this could be opportunity. I just wanted to bring this one up. Any thoughts here?
Good call. From a technical perspective, you may want to hang on and get a little bit more confirmation. But if you're somebody that says, "Hey, I'm full on fundamental analysis," there might be the right set of numbers and sequences of events perhaps coming up that say, "This is my time to get into a company while it's at a low."
Right on, Jeff. Now I'm going to go back to another symbol. So I'm going back to my Dow Jones Industrial symbols here. How about a little DWC TVL for travel?
They're like 5-6 symbols long. It's just pulling them out like, holy smokes, this is incredible.
So here's why I'm bringing up the travel, because we had some upgrades. Goldman today decided that they needed to upgrade some of these travel space, hotel, and leisure area stocks. And that's why I wanted to highlight this. So as always, everybody, remember, our DWC, $DWC will get you started. You can always utilize the lookup tool here in Thinkorswim. And if you just get started with that $DWC, it's going to give you the entirety of the list here, everybody. There are many, many industry groups to work through. Okay. Now, the reason here again is tied to the upgrades. So the upgrades today come on a couple of big ones you're familiar with. Marriott was upgraded from Goldman here. So Goldman upgrades Marriott to buy from neutral. New target at 345, up from 288. Jeff, that's a pretty significant development. That is a big shift. Now, we will always make note of the fact that analyst upgrades, measured moves, none of them are guarantees to be achieved, but they do stand out as potential zones for targets that traders will look to nonetheless.
Essentially calling out a new all-time high, if I'm correct on that, for Marriott, saying
bingo,
banner year coming up ahead. A lot of travel is going to be happening. I would imagine there's some tie-in with the tariffs being relaxed and Canadians maybe coming into the States a little bit more is the sense that I get, but have to read the full analyst report to find out where their thinking is on that.
Well, let's just, the interesting thing to me again is that it's Goldman highlighting multiple companies in the space. Number 2 was Hilton. Goldman upgraded Hilton to buy from neutral, new target at 317, up from 285. They also upgraded Las Vegas Sands, another one in the same space, upgrading Sands to buy from neutral, new target at 80, up from 64. Another substantial adjustment, $16 from 64. That stands out. So 3 big names upgraded, all 3 with reasonably interesting charts, but they also did downgrade a couple in the same space. So let me see here. I had Goldman did choose to downgrade 2 companies that stand out as well. So they are picking and choosing. It would seem to be a bit of a stock picker's market as Goldman thinks about it. So they have upgraded those 3, but then chose to downgrade Caesars. Okay. And
very different chart. Yeah.
Very different chart. I mean, a stock that had been in a clear downtrend below the 200-day. I'm going to draw a line through kind of like this. And the implication might be resistance near the 200-day. We know that the 200 acts as resistance pretty effectively, especially in the midst of a strong downtrend. And unfortunately, you can see it has not been a well-developed chart pattern for Caesars for the better part of the last 4 or 5 years here. So they got downgraded at Goldman to neutral. They had been at buy. and their target is now $24. And then the last one here on this conversation, at least for upgrades, downgrades in this space, is Wyndham. And they were also downgraded, Jeff. Wyndham from Goldman was downgraded to neutral from buy. New target reduced from 88 to 76. And another one, Jeff, where standard technical analysis can keep you at least somewhat involved here. I could see a counter trend rally if it could move through 77, but that doesn't mean that doesn't mean a trader wants to be involved in it, you know?
Yeah. Well, good call outs too. And notice everybody, the chart's very different from the first three that we looked at to the last two. Kevin, I would be willing to suggest that if you were to look at the fundamentals of those companies over the last 3 or 4 quarters, they also have a diversification in the view, some being possibly a little bit better than others.
Yeah, I would have to assume, right? Because Goldman's doing the research at that base level, right? They're looking at the balance sheets, they're looking at the margins, they're seeing here where can this company benefit and where will the others struggle. So there's clearly a discrepancy between somebody like Wyndham and Caesars relative to the three that they upgraded on today. So I think that stands out. And I always want to look at those companies, especially when we're getting a bit of both worlds, right? Here's a couple in this space we're going to upgrade, and a couple in this space we're going to downgrade. It seems it's a lot more comfortable if they just give us, well, we like the whole space. We like everybody in that space. That'd be a lot more comfortable, wouldn't it? All right, I've got more downgrades, unfortunately. Actually, you know what? Let's go back. We talked about staples, and I have 2 staple stocks that were upgraded today. So let's look at those. Now, this one in particular falls favorably into my world at this time of the year. Hershey got an upgrade. Hershey, as you might imagine, come Christmas, it's a very big part of our household. Hershey got upgraded at Morgan Stanley to overweight. They had been at equal weight. New target is 211, up from 195, saying the stock offers rare visibility into significant earnings growth within the staples sector. Jeff, a candle like that stands out to me today. The pattern on the overall chart is a bit messy and all over the map, really. But today's candle kind of speaks to the note today, doesn't it?
Yeah, essentially. And so you notice that we're towards the upper half of that candle. You've also got a little bit of resistance it's got to break past. So let's say it does get past that 190 resistance level. You've got almost like a 195, 198 or so level just below that 200. Yeah, you got it right there. So 196, there's a resistance level. Then if you can get past that one, I should say, if you get past that, you've got another resistance at about 205, and then you finally make it to their 211 level. So that's just a lot of ceiling work that you're going to have to break through to get up to that 111 level. Not to say that it can't happen, Kevin, but I just think it's a lot of work. There may be some easier roads to a bullish argument than Hershey's if you're talking strictly about the technicals, Kevin.
You know what, Jeff? I like what you're saying there because you're absolutely right. Yes, an upgrade is good. Traders like upgrades. But when you see a number of ceilings above you, it can be difficult to work their way through it, right? And it's not a tech stock; it's a chocolate stock. It's a sweet stock, right? So we don't want to get too head over skis with it. But I mean, I enjoy my chocolate. There's no doubt about it. But okay, so a good point there, clearly, but an upgrade nonetheless. The other one in this space is Dollar General. Dollar General, however, Jeff, highlighting a very different chart. This was an exceptional move following earnings. You built a big candle to the upside, and then that a very quick flag that resolved bullishly to this point. Now, trying to continue the break, might be a little tired, but nonetheless, a very vastly improving chart here over the last few months.
Yeah. Now, the idea with the flag is if it continues, so let's say you have that big flag movement from 110 to about 130, 20-point move. The idea is, correct me if I'm wrong, if it can keep moving north, the expectation is another $20 movement, or am I a little off on that? Help me out.
Well, I think you're right on the money. Let's just measure it real quickly here. That shows up to be just about 20 points. Yeah. So a break to the upside from that would suggest potentially 155 as a possible measured move. And then, of course, Jeff, where does that reside? Well, look at that. Happens to catch those prior resistance. What was resistance at the time, perhaps?
We get lucky sometimes.
Come on, you're better than that. Nobody believes it's
Yeah.
luck with you, man. Come on. But that's an interesting development. Is even on the longer term, many of you who
Yeah.
are here frequently, you know that we like to look at these longer windows of time. These weekly charts can be helpful. The moving averages here, the 20 and 40 week, both. So the 20 week just crossed the 100 week. That's my gray one here, the 100 week. And then the 40 week is getting caught up here, the white one as well. So an improving trend regardless. So, on the daily chart, it certainly stands out. We would like to see that, this candle not be rejected at this level. But nonetheless, that is still a bullish on the 1 year chart. And you really would say bullish on the 2 year chart even as well, Jeff, I think, given the breakout there.
Yeah, good movement. Yeah, good call out.
Jeff, I think we are at time. Noticing here
so much fun.
the VIX has climbed a little bit more. We've got everything moving into the red, albeit very minimally in the red, but nonetheless, great conversation today, Jeff. Had a lot of fun having you back. Great to have you on. Thank you so much because you shared a bunch of great info today, buddy.
Always a pleasure. I hope my comments about the January barometer and that potential head and shoulders didn't scare off the entire market. But regardless, it is always a pleasure getting to collaborate with you, Kevin. Thank you so much for having me on your show, bud.
My pleasure, Jeff. Thank you. And thanks to Brent in the chat. Thanks to all of you for being here. Don't forget to follow Brent and me on X. And don't forget about the Schwab 26 Market Outlook, which we posted that link in the chat here for you. We also have the survey opportunity. Jeffrey and I would both value your opinions and your comments. We'd love to hear from you. If you take that 60 seconds, we'd appreciate it. And with that, we'll wrap it. But have a great rest of your Monday, everybody. We really appreciate you joining, and we look forward to seeing you all again real soon.